Well, thanks for being here and for sticking around to hear the tidbits of wisdom that I am now going to try and wrest from these gentlemen. We'll see what happens.
Tidbits indeed.
Obviously, we've covered a lot of ground with all of our various talks in the last while, so I'll see if I can touch on a bunch of those bases and a few other things that I am curious about looking ahead as an investor in this landscape. Obviously, inflation, tightening, this is the overhang or the question that needs to be answered to sort of chart a path forward. So the thing that I'm going to start by asking is, what will get the Fed to stop hiking? So if you think it's inflation at a particular percent, is tightening going to get us there? Is that how we're going to get there? Or is it something else? Do you think we're going to get to some other thing first that might make the Fed stop tightening, debt defaults or US dollar strength and the cycle that it creates? Or what is it that will make the Fed stop doing what it's doing? Because it's important.
Okay.
Anybody want to go first?
Well, my view's been the same through the whole year, and that's it. Wall Street blows hot and cold about this stuff. They're bullish by nature, so they're always trying to interpret anything, any piece of macro data, any comment at any venue by an FOMC member as being somehow dovish. But I mean, my view all along has been, I'm just going to, until I see evidence to the contrary, I'm going to take them at what they say. Yeah. And their comments haven't changed. I think it's telling, and part of the reason why you saw the market come off after Jackson Hole was there were repeated references to the 70s. And it's not that, it's not that Powell thinks it's the 70s again.
Yeah.
He's concerned that the FOMC doesn't make the mistakes that it's widely agreed they did make during the 70s. And that's simply that as soon as they saw some weakening in the economic metrics, they backed off. And I threw a chart up when I did my talk yesterday that showed inflation to the 70s. And it was basically 3 increasing spikes. Yeah. And it really wasn't until Volcker came along and just killed it with 18% rates. They obviously don't want to go to 18%. I'm sure they're not going to have to go anywhere near that. But they've been pretty steadfast saying, we want to make sure when we kill it, it's dead. I don't know. I can't read their minds. I'm not sure what that means, but I think you got to assume when they get to terminal rate that it's going to sit there for a while. And I'm assuming Tuesday, Wednesday, we're going to see CPI, PPI come down quite a bit. I don't know if it's actually going to get back to 2%. That's the biggest uncertainty for me is if it doesn't get all the way down there, does the Fed get really hardcore? Or do they just kind of shift and go, well, 3% is the new 2%, and
right,
this is cool. I'm sure if the market was going to hell, if the economy was going to hell in a handbasket, they would, which it isn't. I mean, I don't think the U.S. is in a recession. I'm not sure it's even that close to it. The one thing, and I alluded to this at the end of my talk, I didn't have time to really go into it, but I think, like I said yesterday, we've got to keep in mind that I think there's a non-zero probability. I don't think it's 80% or even 50%, but definitely a significant non-zero probability we're most of the way through secular change. Mm-hmm. And that maybe not the next year, but the next 20 years, 30 years is base case inflation of 2.5%, 3.5%, 4%. That changes the landscape of the financial markets completely. People don't recognize how big a change that would be. The vast majority of the pools of money that have been big successes in the last 30 years are, pardon my French, fucked in that environment. Most of that stuff will not work. The good news is the stuff we deal with is actually the stuff that works in that environment. Mm-hmm. But it's going to be a messy changeover. But I just don't know. And I think that's really what the Fed's worried about. And maybe that's why the Fed might surprise us with aggressiveness, because what they're really worried about a wage price. And we're not there yet. But if we get there, that's really, really tough to break. And I think they're going to be more hawkish than people think, because I'm expecting a terminal rate of 4% this year, and they might go higher. I mean, and if not, they may let it sit there for a long time.
I mean, the genesis of the question is kind of this endless assumption from huge parts of the market that oh, well, the Fed will have to back off at some point, right? Like because of, and the understated thing is because of the stock market. And so I'm just,
Well, yeah, I guess I probably
Is that even
I
a thing
did
anymore?
wander off on a random tangent, as I've been known to do. It
wasn't that
I
random.
guess I guess the comment I would make is yes, Wall Street, because they're Wall Street and they've got egos the size of a small planet and think they're the center of the universe.
Yes.
Are going, well, obviously the trigger is going to be, well, us, because we're us.
yes. But that's
Not this
actually
time.
the
And he
mandate.
said it
Yeah.
over and over and over again. And they, you get the sense of trying not to be too explicit about it, but I don't, obviously the Fed doesn't think we're in a recession either.
Mm-hmm.
And I think the definition they're going to use is employment. To me, that's the most logical one. I mean, what determines and defines an economic contraction is an actual real reduction in the number of people at work.
Yeah.
We're nowhere near that yet. I think that's what it would take. If there was 2 or 3 months of, 50 or 100,000 job losses rather
Yeah.
than gains, I think that would do it.
Interesting.
I really, really don't think Powell gives a shit if Wall Street drops another 10, 15%. He does not care. That's not going to be it.
John, what do you have to add?
I thought we were going to get CPI figures this past week, and we didn't, and so I checked. Apparently, it's Monday
Okay,
that they're
Monday.
coming out. So
Okay.
we'll
Tuesday
find out.
CPI, Wednesday's PPI.
Oh, PPI is Wednesday. Okay.
Yeah.
So the CPI, the new inflation figures, come out on Monday. My concern is that the inflation we had until recently was due to the lag between supply chain lag between post-COVID demand rebound and the capacity to deliver to the demand for goods. But the China zero COVID policy has really extended that and messed up these supply chains in a bigger way. But now we have something different from the 70s. We have this geopolitical alignment between China and Russia against Europe and North America, with the others all wondering which side to take. And that could be a further disruption of supply chains. If China annexes Taiwan, I think we have a serious problem. And because the companies are already realizing we can't stay producing in China, they're in the process of moving elsewhere, which costs CapEx and OpEx, which means higher costs are going to be facing us for some time. And for me, the puzzle is at what level does the Fed decide to tolerate high inflation that's, instead of like just being a 6-12 months period, is going to be one that's here for several years to allow this transition to a different production base to materials, because this doesn't happen overnight. The thing with the 70s that was so insidious was that inflation expectations became embedded. People assumed it was permanent, and you had that wage cost spiral going. So workers insisted on a cost of living adjustment every year, and then that forced prices of goods up as everybody had to, include those extra costs. And that's what Volcker set to crush. And it took them not just, that 1980-82 period. It took them, I think, till 1986 or so to really wash that out of the system.
Yeah.
And their biggest fear is that we are facing something similar today. But today's also got this interesting demographic problem of declining worker base and an apparent reluctance of younger people to, really work on jobs that aren't that fantastic. So you have that as a, wage inflation pressure that's not going to go away. So it's an adjustment period that we're in. And my biggest concern is that they overreact, panic, and do a Volcker type jamming through the roof, which will collapse the real estate market, collapse asset prices across the board, and really create a miserable situation.
Other than that, Mrs. Lincoln, how was the play?
Brian, do you have anything to follow up on that doomsday moment there?
I guess I would just say
Cheers up, Brian.
that I definitely don't know. I would say that the complexity of the situation is growing, and I see a number of different ways it could come apart. What's the most probable? Again, I don't know. And I'm sure that it's probably something that we don't even see yet that could end up being the reason why this pivot or whatever changes. And yeah.
Fair enough. Peter, I left you to the end.
Thank you. So I don't know either. I mean, I will say that I think that we are going to get into an environment where the Fed and central banks pretty much globally will accept ongoing inflation at much higher levels than we've been used to for the last, say, 10, 12 years at least, around where we're struggling and desperate to get it to 2%. We're going to probably be living with 4 or 5% as kind of an ongoing level. And frankly, I believe that they would be happy with that, because in many ways, especially if rates are, say, relatively below that, this ongoing inflation helps to eat away at massive debts. And so that's important, necessary, not only for governments, because budget deficits are already through the roof, debts are through the roof, but then you've got consumers and businesses that are very, very much debt laden. Look at what the States is doing with loan forgiveness for student debt. And so, yeah, I mean, I just think that it's, in my view, again, probably the way they're looking at the way they're going to have to deal with this is to accept a new ongoing higher level of inflation, probably for decades. And as I say, to facilitate eating away at the debt and facilitate repaying it.
Okay. Well,
I
there's a lot of-
want to throw in one thing. The period we're in now is primed for a crisis. Russia invading Ukraine and basically threatening Europe with, no longer supplying natural gas. We don't know where Putin's going to stop. We don't know what Xi Jinping's ambitions are. But if these get pushed, come to a head, then we get into a different mode, a crisis mode, which will allow a greater tolerance for inflation without crushing interest rate hikes. So I think that's different from what we had in the at the end of the 70s.
I'd like to just add something. Central banks are talking tough right now, but if you look under the hood a little bit, I think and it may not be central banks, it might be governments rather than central banks, so fiscal rather than the monetary side of it. But I think there is a fair tolerance for inflation right now. You can make up all the excuses that you want, but in Europe, we're obviously facing an energy crisis. And despite central banks trying to be tough, you've got Europe talking about an over $300 billion plan to cap electricity bills. You have England talking about, or UK talking about $116 billion program to cap electricity bills for the next couple of years. You have student loan debt forgiveness in the U.S. That's a $300 billion calculated by the Congressional Budget Office, no less, at a $329 billion program cost for the next 10 years. And then you have the Inflation Reduction Act. That's, the biggest oxymoron you could come up with. That is going to be spending another 300 or so billions of dollars, maybe 400, I think. And, this is, this goes against what central banks seem to be doing. It's just that it's the fiscal side. And so there's probably a lag with some of it, but it's going to take 6 months, a year, and that the effects of these things are going to really start to kick in. So they're going to probably undo a lot of the work that the central banks are doing. And if, like John says, you have a crisis kick in, I mean, I think it's really going to, at that point, you get that kind of situation, it's going to be all bets off. Everybody's going to be more than happy to accept, kind of like we saw happen with COVID, and allow printing and say, to hell with it all. Let's just see where it goes. We don't have any other choice. And that's uncharted territory. We'll have to see where it goes. That's my pink picture.
Some can of worm you open.
I guess I asked for all of that by starting with a bit of a doozy. Okay, so if the general premise is that there's a lot of uncertainty and the broad markets are unlikely to gain dramatically until there's more certainty on tightening and what it's going to cause. Traders so want the pause in tightening before they really jump back in. everybody just said, they're going to need to go for a long time, or they might need to go for a long time. Who wants to give an estimate for when it might be time to step back in? I mean, obviously, we don't need to time these things perfectly, but you want to enter broadly at the bottom. And here I'm presuming that metals are just going to get hurt right alongside everything else because that's what they do. And so as metals investors, if we're looking for the right time to enter the stocks that are here or other stocks that we like, bigger producers, whatever it might be, when is that?
4 to 6 months.
Yeah.
Yeah, no, that sounds about right. I mean, if you, the most reasonable estimates I've seen of what the Fed's going to do is 75, 50, 25, 25. That kind of gets you there.
Yeah.
And that's January. And when I say the Fed could stay there for a long time, I think once they stop raising, I mean, Wall Street's Wall Street. They're gonna find a bullish spin on anything. So mark my words, come December, you're going to be hearing pause is the new cut. And as long as rates stay where they are, things will equalize, which they would. I mean, if, you go back to the 70s, 80s, like, it's not like we've never seen 5 or 6% interest rates for years and years and years. It's not, it's not the end of the world. The Fed wants positive real rates, and they've got them now. I mean, pretty much everything on the curve is positive at a real rate sense. That's not the greatest thing for gold, but I mean, the somewhat weak-kneed answered I've given to people for months who keep going, we've got on all this inflation. Why is gold not going crazy? Well, I've always been slightly skeptical about the gold inflation tie being quite as tight as some people think, but it's also because people don't, until very recent, and even now, I'm not sure the market really believes the inflation story. I mean, I think a big chunk of the market still thinks it's transitory. Like, maybe transitory is a year instead of 3 months, but they still think it's transitory. They simply don't believe they don't believe in that thing I talked about, where maybe inflation shifts to 3 or 4%.
They want to go back to
that's
the
what it does for 20 years.
post-COVID party.
Yeah, and most traders I talk to, they do not believe in that scenario. And I think that's part of the reason why they're not buyers. They just don't believe it. The good news is, normally if we do get another large-ish, and I'm not expecting an apocalypse or anything, but we get another 10, 15, 20% down, like in that kind of bear market scenario, gold usually comes out first. It generally bottoms before the equity market does. You go back to 2008, it bottomed 4 months before the equity markets. So we might be close here, which isn't to say it's going to necessarily do anything amazing in the short run.
Yeah.
But it may not get a lot uglier. Unfortunately, base metals,
Just get
if the
ugly
crap's hitting the
alongside
fan,
everything else.
they get shorted. That's just how it is.
Yeah.
So, that's probably the same timeline. Pretty much.
The time to step in is right now, but the real question is, into what? I don't
That
think
was
it's
my
time.
next question. You're preempting me.
Knee deep in the shit.
Okay, so I'll finish
No,
then.
you can carry on. It's okay.
I do expect, metal prices and general markets and that to go lower because the Fed has not stopped raising rates. That's bad news for all the ounce and pound in the ground feasibility demonstration plays. It's also bad news for the prospect generators and also the juniors who are drilling brand new targets for the first time, because the glass is worse than half empty. It's 90% empty with regard to those. But there is a class of juniors who have been doing work, who have been actually accomplishing the beginnings of a discovery, which is why the title of my talk was Emerging Discoveries. And because we're in this really foul mood, expecting things to get worse, you get only very modest, if any, bump in the stock with new information on the table that allows people to do deep dives and see, wow, you're onto something big, and you can get in at almost rock bottom prices. These windows are very rare, and this is one of them. So I think look for the companies, and everybody knows the ones I had, but I would look at like Headwater Gold as an example that I saw here today of like, they have their emerging discovery at the Katy project, and then they have all this other stuff in the background. These are the kinds of stocks, and they're getting minimal reward from the market for their accomplishments. So I think this is a really good time to be focused on these ones where they've already got the beginnings. Forget the Patriot battery metal ones. that's already a confirmed discovery.
Right.
And you can see how violent the move in this type of market can be when you do finally deliver that confirmatory intersection that says, yes, this is it. It's another Voisey's Bay. It's another Icati or whatever, or Fruta del Norte.
Okay, interesting. Brian? The question was timing, if you forget, because
To me, it depends. It depends on a lot of things. It depends on the investor. If I was at 100% cash, I would be 100% buying into the market. I would be buying developers. I'd be buying across the spectrum, but with the proviso that, you know, the time duration of holding those might be longer than a lot of people like to hold stocks. But I've done it before and made money that way, and I'm okay with it. And so it's an introspective view from my point of view. I agree with John. I think expiration is a part of the market where you can make money almost regardless of where we are in the cycle. But don't forget, the expiration companies come with their own set of risks and expertise needed into finding that company. And, you know, that doesn't suit everybody either. So to me, it depends. If you're low on cash, I would sit. That's kind of what I've been doing because I'm lower than I'd like to be. But that's my personal position. But it depends on you and who you are and what you're looking for out of your investment, duration, risk, all that across the board.
fair enough. Okay. Well, you all know what the next question was. I was going to do timing, and then what kind of company, when you are ready to sort of step back in, what kind of company? So I'll start with Brian down at the end so you guys can work backwards. I mean, there was what kind of company, and then I was also going to ask commodity preference, because I mean, I think several of us have stood up here and talked about how the outlook for base metals is very bullish over the medium term. Does that mean that that's the thing that you would buy over the next 4 to 6 months? Or is it gold because gold bottoms first? Or are you just sort of spreading your bets? So commodity, and the two of you have already sort of answered the stage side of the question.
I'm most attracted to the precious metal sector, mainly gold. I think the valuations of the companies are particularly attractive. Most people don't like it. A lot of people have given up. I had numerous conversations today on people giving up on gold, don't believe in it. And to me, that's great. That's more opportunity for me. And again, I don't mind holding the company for a little bit longer if that's what it takes. But to me, the gold thesis is firmly in place. And I think, unfortunately, we will see higher gold prices in the future. And I think within the next 6 to 8 months, I think if I have to guess, that's the time frame I'd put on it.
Okay.
The group, the sort of commodity group that you should be looking at right now is lithium. Lithium has not come down because there's a structural imbalance between supply and demand. It crashed the first time because the Australians were so efficient at mobilizing new supply from their pegmatite deposits. They were a little bit early. But this time around, what was crazy early last year was the realization that despite a 4-year presidency of bashing clean energy and all that, the car companies have completely ignored this and gone all in with transitioning to electric vehicles in a way that was more aggressive than predicted back in 2015-16 when we had that first EV hope wave. And now we have this problem that lithium carbonate's at $30 to $35 a pound. That's 10 times higher than the $3 level it had collapsed to in 2019, 2020. And we really only need $10 a pound for decent lithium-enriched pegmatite bodies to be worth developing. And Eastern Canada has a huge endowment of these pegmatites that were observed ages ago and ignored because the market was tiny. And now we have this structural change where they expect to replace the internal combustion engine cars, new car sales completely by 2035. In fact, California just caught up with the car companies' predictions and made it a law that this is going to be zero sales in 2035. So when people like Rio Tinto, groups like Rio Tinto do the numbers, they say by 2035, 40, we will need, if this becomes reality, we'll need 10 times more than the 100,000 tons of lithium metal that were produced last year. That is huge. The lithium triangle, and Australia can't do all of that. And this is where Canada comes into play. And that extra need, that second half of that million annual tons, that starts to need to kick in by the end of the decade. So the timing is right now for the juniors to go and claw back the moss, start pulling holes in it, do like the Patriot battery metal, show that we're pulling $1,000, $1,500 per ton rock value material at the $30 price, and even at $500 a ton, it's still good if it goes back to $10 a pound, which I think will be the long-term reality. This is the next big exploration boom in Canada. I've called it Lithium Mania 2.0, and it has all that what I was mentioning earlier about emerging discoveries and the S-curve and the response where nobody cares what the macroeconomy is doing. You just look at, oh, how big is this? How rich it is it? How fast are you going to get it to the stage where the big guys come in and start to develop it? So that's the space where you should be looking at right now. And yeah, the ones that have advanced deposits, they're already still up there. They've given up a little bit, but they're still way up there. But there's lots of juniors, dirt cheap, that are acquiring these lands and taking a fresh look at them. And because they were in the game earlier, the market hates them and they have too much paper out and they're dirt cheap. So this is like a fabulous window right now to look at that lithium hard rock space, especially in Eastern Canada.
Eric, what stage and commodity would you be interested in entering over the next 4 to 6 months?
There's probably two. I mean, there's companies that have, to me, look like they've got something that's for real, that they can significantly increase the size of, and it's got to be, for me, it's got to be something that has grade, and ideally the company involved has got to not have an empty or anywhere near empty bank account. Because I kind of agree with Brian's comments that, because we didn't really ask time horizon, and if you're thinking 4 to 6 months, yeah, you might get whacked down 30% on some of the stuff you buy now, but welcome to the resource sector. I mean, if you can't handle that kind of volatility, you're in the wrong room for sure. So it's a good time to be looking. I mean, it's no big secret I like drill speculations. It's a sickness. I have it, unfortunately. And certainly, I mean, I invited Headwater here. That's certainly one of them. But companies like that, that they don't have a resource yet, but there's obviously a discovery. And I'm like you look at a company like Pacific Ridge, like, yeah, they're obviously going to drill some good drill holes. I mean, if copper goes to 250, is that going to help? Well, no. And a lot of these companies, it's going to come down to, are they putting out, do they have the bad luck to be putting out results just when the market's really taking a nosedive? And that, maybe that's what happens. The other thing to look for, and this is where time horizon comes in, this is a little riskier. So I would also agree with Brian's comment. This is something you'd be doing if you had a fair amount of cash in your account. And I'm assuming that people doing this would be accredited. And that's, you look around, and if you look around and you find, say, 10 or 20 companies where you like the management team, you like the projects, they didn't hit the window when it comes to financing. Things are getting down to fumes. And, you put on your Rick Rule mask and go, I love full 5-year warrants. Yeah, the market sucks. Yeah, maybe I'm a bit of a dick, but I still like full warrants. And sure, if you're doing a 5-cent financing and stuff like that, like some of those, when you do those, they're going to go up in smoke. Like if you're doing that, you have to understand that some of these companies are just going to disappear. That's part of the calculation you have to do. But if you're willing to, the old saying, if you're willing to buy when there's blood on the streets, quite often that really is where the money is made. There's a saying in technical analysis that when the time comes to buy, you won't want to. Nobody wants to right now, which means it's probably time to buy. And I don't see an obvious short-term catalyst for gold, for instance, but I totally agree. The sentiment is so bad that it's hard to believe a lot of these stocks are going to go a lot lower because everybody hates them.
There we go. Peter, I mean, commodity might be an obvious answer for you, or maybe you'll surprise us on stage.
I'll surprise you.
Okay, good.
So very near term, I would say gold and uranium. After that, I would say between near and medium term, I would say silver because of the industrial side. And so it always has a lag on gold. It's not going to kick in probably quite as quickly. It does surprise sometimes, but on average, no. And then after that, after silver, I would say base metals. And I would agree with looking at companies that, as you know, a good balance with some risk. Looking at companies that have existing deposits that have been proven up, ideally relatively recently, and like you say, maybe somewhat lowish on cash. And look at that. That's probably where I would start. As the prices of these commodities start to move up, then you'll get the full effect of the leverage. Yeah, that's the way I would go about it.
Okay. Let's move on a little bit to some more stuff about the mining sector, not necessarily investing in it in the moment. There's all kinds of challenges that the mining sector has faced over the last few years, from, you know, a complete absence of investor interest to all number of other things. And that has created some interesting scenarios for us, like a complete shortage of new supply in metals that the world needs a bunch more of in not very many years. Where in that sort of quagmire do you guys see the biggest problems, and then maybe also the biggest opportunities? So what are some of the biggest problems that are facing the mining industry right now? Do you see them changing? Do you see those manifesting as opportunity for investors? I mean, we've been in a very up and down, challenged few years. Yeah. So what kind of thoughts have you been pulling from those years?
If I can, I'd like to go first, because anybody that was not at the Q&A after the companies that I presented would have, you know, a lot of this was addressed actually. So it was a really stimulating Q&A. I thought so. The presenters thought so. And so one of the things that really came up was, you know, a lot of gray hair in this industry. The average age, Greg Johnson of Metallic Minerals was saying that the average age for workers in the mining industry is 55. That's unless retirement age, which wouldn't surprise me, gets pushed back, that's 10 years away. So a lot of these people will need to be replaced. And when you look at the sort of the sustainability and the environmental side of things, the lack of people, and the cost of training people. So Morgan Lekstrom of Silver Hammer was mentioning the potential on the technology side. He thinks that automation is going to be a big thing coming into replacing people to some extent, helping on some level with sustainability and helping with the environment. But obviously, as we see, less and less people seem to want to work, especially in lousy jobs. People who can perhaps, if you have technology that is relatively advanced, it's also going to perhaps require fewer people, but at a much higher skill level and much higher pay level to perhaps oversee and or operate this equipment. And so that could be an exciting side. And certainly there are lots of developments in this area. That's an angle to watch for in where things may be headed.
Yeah, I mean, personnel is a big deal. I mean, that's something that I hear over and over and over again from people running these companies. And sometimes you get windows where things improve. I mean, you know, like my Q&A, that's something that was brought up by Caleb, the guy that runs Headwater. He said, you know, and he said the one good thing about this year being slow for a lot of companies and a lot of companies cutting down or cutting out even their exploration programs, he said, I've actually been able to nab a bunch of people from other companies in the last 2 months, because he said 3-4 months ago, he said, if I'd done this deal with Newcrest 6 months ago, he said, I don't know where I would have found the people that run the programs. And, you know, there are geology programs out there. I think there was a trend for a long time, even within people doing geology degrees, everybody kind of leaned towards the environmental geology, or, you know, let's go get a job with the county monitoring slope stability and stuff like that. They weren't turning out economic geologists. That is going to be an ongoing problem, and it may be that what you get is a lot more people coming in on visas. I mean, God knows they they certainly graduated a lot of geologists in places like China and some countries in South America. The level of training is open to question, frankly. They're probably going to need a bunch of added training. That's part of it. But the other things that's the other big ongoing issue for mining too is, I don't know, this sector seems to be just terrible when it comes to capex control. Like every time there's an inflationary period, miners seem to manage to outdo everyone else with their costs going up. Like
blowing out their
it's just crazy.
right?
Like never, it happens every time. And the other big thing obviously is permitting. I mean, if everybody wants this transition, and I think everybody does, to call it what you want, green energy, and you get these huge shifts and you need huge amounts of things like lithium, like John was talking about, people that are pushing for that transition, at some point, there's got to be a come to Jesus meeting. And look, if you guys want this, whether you say it or not, or admit it or not on the hustings, you want 50 more open pits. So who's gonna stand up and put their hand up and say, yeah, I'll give that thing a permit? Yeah. Because if you're not willing to do that, it ain't gonna fucking happen, folks. Like, sorry. Like, yes. A has to come before B. So there's got to be some light at the end of the tunnel with permitting. And Canada's not bad. I mean, it really isn't. I mean, it does have a process, and unless there's some underlying issue, or there's like a big First Nations issue, and if you didn't know that before you got to permitting, then you did a bad job of running the company. Yeah, like you should have known. It's not bad, but a lot of jurisdictions, it's just we're not getting there unless there's some way to streamline that process without. And I'm not saying we streamline it by throwing away all the environmental controls or anything like that. I just mean there's got to be some way to shorten that. Otherwise, I don't see how we get from A to B. Like,
how we produce more lithium and copper. Yeah. John, biggest problems?
It's interesting, and in my Q&A, the same topic about personnel came up, and it was drilled down into drillers are a huge problem. Competent drillers, there's a shortage of them, and this is causing delays or very slow programs or inefficient core recovery. And then the question turned to like lab turnaround, and much of the labs are automated, but the prep portion isn't, and that isn't exactly a rocket science job, but there they are finding shortages of people also. So this is a problem that the exploration side of the industry is running in. And as Eric says, this inflationary period is introducing its new round of CapEx increases and OpEx increases, and these will be sticky. And at the same time, we have this perverse phenomenon of the metal prices going in the other directions, crushing the margin even more. And this is, of course, a reason why the market's not so excited about advanced projects going forward. The companies with existing operations, they're reluctant to build new mines because they know they're going to be building them at a higher price with declining metal prices. They'd rather just not bring new supply on stream to help build the electric vehicle fleet with more copper mines and all that, and just end up reaping $12 a pound copper down the road with their existing sunk capex, which is not inflating except for whatever sustaining cost work that they have to do. So it's this inflation. We're going through a similar round that kicked in at the start of this decade after the big increase in prices. That's going to be a problem for the sector. Plus, of course, as Eric also says, permitting, but also local, not in my backyard opposition. And this is becoming a serious problem in Latin America. And it's also a problem in certain communities in Canada where Indigenous people have jurisdiction. Some are great. They want to get wealthier and have a better future and work with the companies. Others, they get invaded by trust fund children, babies who go there to encourage them to save the planet by not building new mines so that the energy transition can happen. This is an ongoing problem.
Brian.
Yeah, I agree with all of that.
Right? There's been a lot outlined already. Nobody's really talked a lot about opportunity, but there's been a lot of problems.
What I would say is that all of those things make me more and more confident that the future of mining looks great from the perspective of all these problems are going to lead to probably higher metal prices. And, when you constrict supply, those are always the strongest markets. And to maybe add, the only other thing that I would say is maybe perception by the general public is maybe a little bit skewed towards mining, that it's it's this or it's that, dirty, blah blah blah, kind of the not in my backyard mentality. But yeah, I don't think I have anything to add besides that.
Yeah, fair enough. I mean, there's been a bunch of problems listed here, and the Q&A conversations and conversations that I've had with all kinds of other people in the industry here over the last 2 days, a bunch of the same stuff. One person I was talking to, was just out for a few days with a bunch of people from major mining companies, and the conversation on an annual trip. And the conversation there is always interesting. What are the major mining companies like? What are the guys at the mining companies really talking about right now? And what they were talking about is the need for operational excellence and the lack of teams that can offer that. And how when you don't have it, you get all the capital blowouts that we've had at these projects that have been built.
Yeah.
And there's an interesting thought process that kicks off with, well, what kinds of projects then do teams want to build? The bigger the project that you take on, absolutely. A few big projects is more efficient for a company to run than a whole bunch of small projects. But big projects come with big price tags, and then they come with really big capital blowouts when they don't work. So that's what kicks off a cycle that the industry goes through with, we should build really big projects. Ooh, that didn't go so well, because we're always short on people in the mining industry because there's a lot of perception issues with getting people to come into the mining industry. Okay, maybe we should build smaller projects, and then, oh wait, now we're inefficient because we're operating too many small projects. So we should build big projects. And there's this, it goes around, and we've had it go around a few times. And we're in the big project stage right now because there's been so much streamlining from majors since their portfolios were too cumbersome during the bear market. So it's interesting to see where that all goes, but it was interesting to hear that the majors are really talking about operational excellence. And so one concept there is that maybe some of the M&A we see in the next little while is about team building as much as it's about asset movement between companies. It's about, okay, well, this team at this company is really good at this, but it's a bit deficient in this, and this company is very good at that. So maybe it's driven as much by people as anything, which was an interesting concept that
Yeah, I've always kind of expected to see Silvergrass bought out. Well, and I'm sure they will get bought out because somebody really wants Eric Fair. But the only problem is I know Eric fairly well, and I'm pretty sure he's going to be like, peace out.
Right.
Thanks for the 50 million. Gotta go. Bye.
You can't just buy people, unfortunately.
No, because there do seem to be some teams, and he's just an obvious example. I've always followed his companies. He builds mines that don't appear to go over budget, and they don't appear to go past cash costs that he talked about. And why does he do that when the 5 other guys don't? I mean, I literally don't know what he's doing differently, but that's certainly what the industry needs to do, is figure out what, and he's not the only one, there's other guys, other people, sorry, Gwen, like that, that where they have to figure out what those people are doing right and start training it up. And the one, I as a guy that was born into the mining sector, I'm fairly cynical about this happening, but I'm hoping part of what comes out of this with more green metals, minerals, whatever getting mined, people recognizing the hard way, and by the hard way, it'll be when the prices go up so high that all these companies make a ton of money. At some point, I'm hoping that means maybe miners get a slightly better reputation. Like, yes, we do actually need those people. Like, we can't, industrial modern civilization, green or otherwise, cannot exist unless those people are out there busting their asses making those metals disappear. I mean, is it too much to hope that at some point the sector isn't attested? I don't know. I'm hoping.
Okay, one more sort of mining sector question. I've been talking a lot about copper over the last year and the deficit that's coming, and that's why I'm bullish on it on the medium term. And almost every time I give a talk like that, somebody comes up to chat with me afterwards who says, yeah, but people have been forecasting a copper deficit forever and it doesn't happen. So is it different this time? I'll start at your end of the table, Brian, just for a change. But are the deficits that are being forecast across many metals, but base metals in particular, obviously, so nickel and copper and lithium and silver, are those deficits different this time? Is there something structural? Is there something global or fundamental about those deficits that's different this time? That means that those people who come up to me and say, yeah, but you can't, but people have been talking about a deficit in copper in 5 years, for 20 years. Does it make it different this time? And if it is different, what does that mean might happen to prices and opportunity?
I think it is different. By the same token, I'm going to speak out both sides of my mouth. I'm going to say it is different, but it still does depend how things kind of happen over the next 5 to 10 years. If I had to guess, I would say it's different in that it's going to be very positive for the copper market because there's not going to be enough to adequately supply the market that's growing in this green revolution. Whether it's the car makers or a number of businesses have transitioned themselves already, regardless of where the public thought may be, have already transitioned into the green revolution, and it's coming. And I think the only thing that I might question is whether the demand side, depending on how this stuff kind of rolls out in the next 6 months and what the future looks like, whether people can actually afford a $100,000 EV. Or maybe if you even buy EVs in the future, if it's more like the Zip Car or these rental places where you rent everything, and how that affects the demand curve. Like if you look at EV sale or car sales and they say 30% adoption, but 30% adoption of what? It was $100 million or 100 million car market in 2019, and it's dropped every year since. Now we had COVID. But I think like the big question mark is what does the total size of the car market look like? Are people going to change their habits? The car makers may be only making EVs now, and jurisdictions may be only mandating or not allowing you to buy IC engines in their jurisdiction after 2030. But again, what's the size of that market? And I think that's the big question mark. But I think irregardless, I still think it looks very good for copper in particular. Because everything is going electrified, and that process is already in place. And then all those difficulties that we talked about to do with mining really affects the base metal market, in particular copper. And they're just not discovering and developing quick enough to meet up with that future demand. And even if it stays level, in my view, anyways.
I look at I track the warehouse stocks of all the key metals, and it is stunning. The combined LME and Shanghai stocks, warehouse stocks for copper, nickel, lead, zinc, tin, they're almost as low as they were in that 2007, 2008 period. And yet the global economy is substantially bigger today. And then we have entirely new demands coming in, such as copper related to the EV rollout. It's incredible that we're seeing the metal prices retreat at this juncture, despite warehouse stocks being so low. And if we do survive this period coming through where we're worried about how high interest rates are going to be, there is going to be a very sharp rebound in metal prices, because right now the IMF's GDP predictions for the next 5 years shows a substantial increase building upon current metal consumption. And how's that going to be possible with the existing supply system at a stage where the warehouse levels have dropped to what are probably historical lows? So that's a really, really interesting situation right now.
Yeah, I mean, obviously, the farther out you look, the more dangerous the statistics get. But I've seen generally, 3 or 4 or 5 different studies that are generally in agreement. And they're really, all of these studies are based on assumptions about adoption, and a lot of those assumptions are based on basically what governments have said they're going to enforce in terms of the amount of adoption. And you work the numbers backwards, and you get. Right now, the global copper market's 20 million tons. That's how much copper gets consumed in a year. You take it out to about 1935 based on these assumptions, and the copper market's about a little over 33 million tons, give or take, between 2030 to 2035. You take it out to 2050, you're up to 53 million tons. You basically have to increase copper supply by 4%, 4.5% a year. I mean, that doesn't sound like much, but I mean, I've been around the mining business a long time, and the long-term average, good times and bads, and especially through a couple of great base metal bulls when everybody was building stuff as fast as they could, it averages like 2.5%. And that doesn't, somebody that doesn't know the mining business goes, well, 2.5% to 4.5%, how hard can that be? Like, it's really freaking hard. That's how hard. That's like building extra La Bamba every freaking year. Like, that's really, really, really hard.
And try and permit a single La Bamba.
Well, yeah, I had
Exactly.
one of those people, like the people that you were talking about, somebody I don't know on Twitter, he sent me this list of, well, here's the 100 copper deposits that are going to create this big supply deficit. And I'm like, all you've proven is that you know nothing about the mining sector. I can run a line through 45 of those right now that are never, ever, ever going to be permitted, ever. And I can find you another 30 on the 55 that are left that copper is going to have to be $9 for them to make sense. So bring it on. Great. Awesome. But the people look at that stuff and they go, well, that's how easy it is. It's like, yeah, why don't you go to that mine site and see who's standing at the gates and go, can you guys give me a mining permit? Like, good luck with that.
Dad?
Not a lot. I would say I agree with what John was saying, that, if this whole green we're at the point where either you figure there's some sort of blow up globally that just says we can't afford this anymore, it's just not happening, or if you continue with this kind of sentiment, then you just that goes on for a while longer. It can't be too much longer. Maybe 6 months, maybe 12 months, maybe 18. Really, if you're going to stretch it. But like John was saying, you're just going to have this sort of hockey stick adjustment to the prices, because we seem to be in denial in terms of what we want, what we're expecting, and how we're going to get there. So yeah, I think that it's just going to be a shock kind of to everyone, probably us as well.
All right, we'll wrap it up with a pick a stock question. But instead of just naming your favorite stock here, because then you'll all name one that was on your panel, and that's fine, but we already know that you like those ones because you invited them here. How about, have you found one here that you didn't know about that has piqued your interest? So, I mean, hopefully that's one of the reasons that we come here. We love to talk to you. We love to answer questions and learn what we can from everybody who's here. But we're also here looking for stocks that are of interest that we didn't realize had something interesting going on. So, Peter, was there one that caught your attention?
I have to say no. However, I will repeat something that Eric said when he brought up Silvercrest.
Silvercrest. Yeah.
And that is that that would have to be my sort of single favorite pick right now. I just think that they're so far ahead. Like you said, Eric, the other Eric, did such a great job of building this. And that if anybody is leveraged and primed to take advantage of a much higher silver price, it's them. I mean, the odds of doing badly on that stock at this time are in my opinion very low. That's definitely where I would go. Silvercrest.
SBL.
Eric.
Yeah, I mean, I've got a couple here that I'm still talking to, and I wouldn't say.
I mean, I guess if you can't find one here, one that's attracted your attention recently, I can broaden it a little. But
there's a couple here, but I've still got a bunch of questions, so I wouldn't say.
Sure.
I wouldn't say I flipped the switch and said, yeah, I really like that one. The Silvercrest is a great one, but I mean, I like Visa a lot too, because the Visa is just, I love the grades those guys are finding in the new zones. If there's anything that's close to being an equivalent to Silvercrest deposit, it's that one. I mean, I think that's going to be 200 or 300 million ounces for sure, like in the bag. They got to drill it, but there's no way it's going to be smaller than that. And the average grade is going to come up. And the other one too that the market has a love-hate relationship with it, and I understand it. Management did some not super intelligent things in the past. But that's a company called Max Resources, because just on the copper theme, I really like that project. A good friend of mine in Geo kind of bugged me until I looked at it, and it was like holy crap! Like this is part of it's Cooper-Schiefer, which most people don't even know what that mine is. Cooper-Schiefer is a copper silver mine in Poland. It's been going for 200 years now, I think. It is, in fact, the biggest silver producer in the world. Is not in Mexico. It's in Poland. It's Cooper-Schiefer. Part of it's that, and part of it, it might just be structural. It might be a change in tenor, but the newer stuff, which is where they're going to start drilling, that's a bit more like African copper belt. And this is stuff where they're sampling, 10, 15% copper across 10, 15, 20 meters. It's basically just chalcocite. There's no other sulfides in it. It would be very clean. Those guys are supposed to be drilling towards the end of this month, so that's one I would. And yes, it's a drill. Yes, it's a drill spec. My bad. But they also have lots of cash, so I'm not worried about them having to go to market in a crappy market or anything.
Yeah. That was Max Resources
Max,
for
yeah.
those who
Max
didn't
is the
catch
symbol.
his.
MAX.
Yeah, so I've already mentioned the company earlier that caught my attention. It came to my attention a couple of weeks ago when they announced the Newcrest deal, which was a very strong deal. But today I got to meet them and connect with them and dive deeper into it. So Headwater Gold is the company here that isn't in my group that I would be proud to have in my group as part of sort of this emerging discovery type of a junior. And if you want something else that isn't here, tied into my lithium story, at the Toronto show, Brunswick Exploration is the junior that's probably going to be foremost in the Eastern Canada pegmatite hunt. It's Bob Ware's behind that company. So that's the one if you want a very broad-based lithium grassroots vehicle that could have multiple discoveries on the go and become sort of the go-to stock for when Lithium Mania 2.0 kicks in. Now's the time to take a shot at that one.
The placement I should have bought.
You were offered it?
Yeah, I was offered.
Now I know what's going on.
Brian. Well, these two fight over who gets offered with financings. Brian.
So a company that I've actually been talking to for a while, and it's been on my watch list for probably a year, is North Isle. I think they've got a good project on Vancouver Island. I really like the CEO. Sam Lee is amongst, probably the best CEOs that I've met, but haven't invested in. I think that's a company you may want to look at, and fits in kind of what we're talking about with this copper market. A company outside that's not here that came with me that I really like is Montage Gold, Hugh Stewart. They've got the Koné project in Ivory Coast, around 3 million ounces. They just did a deal with Barrick and Endeavour to further consolidate some more land north of the Koné project. I think they're going to put together or make a discovery on this new property that will fit in nicely with Koné, and they're tremendously undervalued. So that's another company I'd look at.
I would say the ones that caught my attention, those who follow what I write know that I'm pretty interested in uranium these days, and I should have been more aware of Canalaska's intercept, and so that's the one that's piqued my attention here, just to answer my own question.